Next, we'll go to Steve Leisman from CNBC.
Thank you, Mr. Chairman. I wonder if you could perhaps give us your thinking about the trade-offs between inflation and unemployment. You've talked about the shortfall in unemployment or employment relative to before the pandemic, and yet you have inflation, which is affecting everybody. Are we at or close to a point where the risk of inflation is greater than the benefit that you'd for recovering these lost jobs, so that now from a risk management standpoint, it makes sense to move more aggressively on rate hikes? And kind of a related question, the statement today says you'll keep policy accommodative until you hit that 2% inflation target. Our surveys show looking for 5% inflation this year, 3.5% next year. It sure seems like you're on track to modestly or moderately exceed that 2% target. Thanks.
Yeah, so I'm not sure I totally got your first question, but I would say, in fact, could you just quickly, succinctly say your first question again?
Sure. The idea that the trade-off between inflation and unemployment, that you would keep policy accommodative to put this 5 million folks or find these 5 million jobs again. At the same time, all Americans will be suffering from higher inflation. Is that trade-off worth it, or is it better or smarter to raise rates right now to combat inflation and perhaps not lean so heavily on the employment side of the mandate?
Yeah, so this isn't the traditional Phillips curve situation where there's a direct trade-off, where that's really what we're talking about. The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off. But in this situation, we do have a provision in our statement on longer run goals, as you know, that says when those two things are in tension, what we do is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with the mandate. So we used to call that the balanced approach paragraph. We have to think about the amount of the deviation. We have to think about the time it will take. And we have to make policy in a world where the two goals are in tension. It's very difficult. But what it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year. We see well into next year. We see higher inflation persisting, and we have to be in position to address that risk should it become really a threat should it create a threat of more persistent longer-term inflation. And that's what we think our policy is doing now. It's putting us in a position to be able to address the range of plausible outcomes.